Welcome back to the Wilson Weekly on the Money Mentor podcast, everyone. I'm joined, as always, by the star of the show, Dr.
Thank
Andrew
you.
Wilson. Doc, how are you going this week?
Yeah, good, Chad. Good to see you again. And we are really rushing along to the end of the year at the moment, aren't we? We've only got 5 weekends left in the real housing market energy, I guess, and that's our weekend auction activity or our weekly auction activity. So then it's all over Red Rover until basically February next year. But of course, there are some markets that are quite energized through the holiday period, particularly the Gold Coast market. It has a massive auction day in January, which is a very popular, and a lot of course, the other sort of regional seaside or holiday markets attract buyers, people on holiday. Hey, I'd love to live here. And that means that some of those markets are also energized through the holiday period. But generally, of course, we're all on a break. We're waiting for the resumption of the year, but we've still got some way to go. So let's not write the year off yet. Still got the best part of a month to go before Christmas. So I hope everybody's really working on those Christmas presents, because time is running out. But having said all that, let's get started.
Right, take it away, Doc. I'm looking forward to seeing what to expect heading into the end of the year.
Well, as usual, my brand is My Housing Market. We act as independent commentators and data providers on the housing market, and we're significantly all about the current state and future prospects of housing markets, most particularly the current state. So every week we bring you the latest data so you can put together that jigsaw puzzle about what is actually happening here and now in the housing market. That's all what it's about, evidence-based commentary. And we have plenty of evidence, and we provide it to our viewers and listeners every week on the podcast. So it is the week to Wednesday, November the 20th. And this is the data we're going to look at. It's, as I mentioned, those September home loans. That's the monthly home loans, the September quarter wage price index, and the latest auction results. So let's get started. Home loans have started to steady a little bit over recent months. Now, we've got to just have a couple of disclaimers here. There've been some issues with the home loan data over the past year or so. The ABS has been sort of upfront about that there firstly were problems with the seasonal adjustment models because, of course, COVID turned everything upside down in terms of seasonal adjustment modelling because weak months were strong months and strong months were weak months through COVID. So that upsets the modelling for seasonal adjustment. And also the ABS said it was having some issues with its data collection, and its data obviously comes from the banks, home loans, and APRA. So I think that's also part of why the ABS is now switching to that quarterly data set. And also I think there's some cost cutting going on as well from the ABS, but that's what they've declared. But so we'll enjoy the last couple of months of the monthly data series. And the September results did show that home loans were steady over the month of September compared to August. When we look at the breakdowns in terms of buyer types, we can see we've had really strong growth really over the past year or so in home lending. Now that's no surprise because we've seen reasonably strong growth in house prices. So higher prices mean you've got to borrow more, so that pushes up the value of home lending. But all the buyer groups there, first home buyers, investors, and general owner occupiers were down or flat over the month of September. You can see there that owner occupiers up marginally by 0.4% over the month, investors down 1%, and first home buyers down 3.3%. But that monthly data tends to be volatile in a sense. And when we look at the year-on-year or the year-to-date data, it gives us a better picture of how how the various buyer types are performing. And gee whiz, look how strong investors have been over the past 12 months. Investor home lending is up 30.1% over the first 9 months of this year compared to the same period last year. First home buyers up 15.4%. Owner occupiers generally up 13%. That's the first 9 months of this year compared to the same period in 2023. So a real rebound there from investors. No surprise that investors are so active. Rents are rising, yields are higher. And of course, most markets are experiencing strong capital growth as well. So that has certainly acted as a magnet for investors. And we can see there that investor lending has really skyrocketed. And over the year, the full year to September versus the full year to September last year, investor lending up 26.3%, which is certainly significantly higher than the other buyer types. So I guess if you follow the money's telling you that investors are up and running in terms of the housing market at the moment. And as I said, given the strong factors in the market, that's no surprise at all. And maybe some good news for...
We absolutely need them. We need investors running into market. We're in that housing crisis. We need that activity up. So I'm glad they're at least not being scared away, despite 1 month of the results sort of plateauing a bit. But as a whole, great trend.
Yeah, that's right, Chad. Look, that's a good point because, you know, that's good news for the rental market because it means there's more rental properties coming in. We've seen not only a plateauing in that home loan data, but a bit of a plateauing in the rental market as well. Now, I'm not saying that's a result of the a significant result from the point of view of more lending, but it certainly must contribute to it, seeing how strong investor lending has been over the past year. And of course, that means more investment properties. And I think that's part of what's at least eased the supply and demand mismatch that you mentioned there in our rental markets. There are other factors involved, but again, it's good news for a more balanced environment for our rental market to see more investors, because we need investors. They aren't the bogeys of the housing market. They're actually, in a sense, a very important part of our housing market, which does keep it balanced, robust and resilient, and provides millions of Australians with a roof over their head that normally they would certainly struggle to afford. And, some of those loopy policies that are being presented out there by the usual suspects trying to get rid of investors, thinking that it will mean a surge in potentially first home buyers. The only way you're going to rebalance that particular market, first home buyers versus investors, is to have an exodus of of investors. And if you have that, the only way that's going to attract more first home buyers into the market is if you have a significant fall in home prices. And I'm not sure governments are going to be terribly popular with the voters if they are responsible for big falls in home prices, going forward. But that's a discussion for another time. But when we look at the breakdowns here for the states, we can see, no surprise, how strongly those boom states, the boom capital cities of Brisbane, Adelaide and Perth have been in terms of the state lending. And this is the year to date. So it's the 9 months to September versus the 9 months of last year. Look how strong. Queensland, 33.6% increase in home lending over that year to date comparison. South Australia, 27.5%. And Western Australia, that booming Perth housing market, home lending up by 38% over the first 9 months of this year compared to the same period last year. Certainly well ahead of Victoria and New South Wales. New South Wales still rising reasonably strongly, up by 16.4%. Victoria up 5.9%. Now we have to mention, of course, that this is the value of home lending. And we know prices have risen steeply in Perth, Adelaide and Brisbane over the past year. So obviously you've got to pay more for your home loan to get the price. So there's that price inflation that's working into that increase. But even accounting for that price inflation, that's, a very strong increase. And again, it's relative to the other states where Melbourne hasn't had the same growth as the other capitals, and Sydney, although growing, hasn't grown as strongly as the big three there. So, but nonetheless, as I said, this validates what we know from price data, that people are borrowing more, and it's those three states reflecting the strength of their capital cities that are well and truly ahead of the other states. So when we look at the breakdowns there, this is really quite spectacular in terms of investors versus overall owner-occupiers. Look how strong the lending has been for investors over the year to date versus the same period last year. Queensland investor lending is up 49.8%, South Australia 57.4%, and Western Australia home lending up 50.8%. That's a real surge in investor lending. So that's not just accounting for that price inflation environment. It's also showing that there's real growth in demand for investment properties in those particular capitals. And, look at Victoria as maybe just continuing that sort of political theme I touched on, but just a 5.5% Victoria, which is well below Queensland, South Australia and West Australia, and New South Wales, up 28.1%. But, you know, I think part of the issue, certainly in terms of confidence, has been those new policies that were introduced by the Victorian government a year or so ago as a response to their financial issues through COVID, to rebalance their budgetary position, that they introduced some changes to land tax, which, you know, has really, I believe, been a factor in certainly, and that's been my experience on the ground, you know, impacting confidence, particularly in the Melbourne housing market. So I think that's an instructive reflection of, you know, investor sentiment in the capital cities there, but some big numbers there in those Queensland, South Australia and Western Australia markets. We also look at established versus new housing. We know that we've undersupplied ourselves in housing. This is another example of that. This is looking at lending for established properties versus lending for new properties. And you can see there that the relationship between the volume of lending for new versus established has really fallen away. And that's just another sign people aren't, you know, buying new homes, and the lending for them is certainly, they're buying it, but not at the rate that they're buying them for established homes. And you can see when we look at the proportion of new home lending versus established home lending, it's way down at near record low levels. So still not out of the woods in terms of at least, and it's another correlating data set, you know, not just building approvals, but these are loans for new homes, and they're well below the mark compared to established going forward, and we need that to rise. The other thing we can get from that home loan series is affordability. So My Housing Market produces an affordability index, which looks at the proportion of the average loan or the average repayment for the average loan compared to the average wage of each of the capital cities. And we can see part of the reason why that Perth housing market is booming is it's because it's the most affordable in terms of home lending affordability, because, of course, Western Australia has the highest incomes in the country, but its prices are still below Melbourne, Sydney, Adelaide and Brisbane. So, you know, Perth buyers can afford to keep bidding up because they've got higher incomes and they're paying less notionally. So when we put that together in an affordability model using the ABS home loan data as a benchmark, we can see there that there's a significant disparity between the affordability measures in Western Australia compared to the other states, and that is what is continuing to drive demand in the Perth housing market. So that's our home loan data. I think was quite interesting and validates what we've sort of been saying for some time anyway, but just tapering off at the moment, but can be a little volatile from month to month, that series. And I think it's one of the reasons the ABS is maybe because that volatility reverting back to a quarterly data set rather than monthly. So wages growth has slowed. We've had some very big wage rises over the last couple of years. Of course, we've had a very tight labour market, in fact, probably the strongest labour market in our history, all things considered. And that means that employees have had the leverage to bid up their wages. Employers really haven't had much choice because of a shortage of labour. So they've been paying those higher wages. Well, up until now, we saw a big fall in the change in annual wages over the year to the September quarter 2024, up by 3.5%, but that's well down on the 4.1% that the annual wage growth that we recorded over the June quarter. But the ABS has noted that that perhaps this change in wage rises is linked to the Fair Work Commission's annual wage review decision. Obviously, they do every year their annual wage review. Their latest decision was a 3.7% wage increase from the 1st of July 2024, which was a lot lower than their previous decision of 5.75%. There was a bit of criticism for that 5.75% because there was some commentary that would stoke inflation, but they've certainly gone backwards quickly in terms of those wage rises. And look, it's actually good news. It's not good news because we want to keep getting higher wages. We're still tracking above the inflation rate, so real wages are still growing after a couple of years of real wages below the inflation rate, or certainly nearly a couple of years. But the problem with high wages growth, as I mentioned, from the Reserve Bank's point of view, is that employers in a tight labour market are sort of leveraged to have to pay higher wages, or else they lose their staff. They know that. They don't want to lose their staff. There's not a lot of competition out there amongst workers for jobs, because there's plenty of jobs and not so plenty amount of workers to bid for them. So that means that employers have to cover those wage increases. And if they don't have productivity gains, and they're certainly not, productivity is not growing at the levels we've seen, those 4% plus rises in wages, annual wages recently, then they have to raise their prices to cover the wages. And that's inflation. So the Reserve Bank would actually be a little bit happy to see lower wages coming through, because it means, that there's not that same, energy or motivation or need to increase prices by employers to cover those higher wages. So, some better news there in terms of wage increases. As I said, we're not happy about that. We want more wages, particularly where prices are still high. But at least the positive there is that it is another factor which the Reserve Bank will be considering when and if they decide to cut rates. So this is the chart for the wage increases, annual wage increases from the ABS, the National Wage Index. You can see we've been tracking in the low fours for the last few months after rising steeply, and we were just below those really strong levels we had back in that massive mining boom we had in the noughties. So that's very strong wages growth, and again, it reflects a very strong economy and a very strong labour market. But you can see how we've dipped down from the peak last year of 4.2% to 3.5%. So, and it's well above where we were prior to COVID at just 1.3%. So, as I said, we still want to see wages growing. We want to see that sort of relationship between wages and productivity growth being re-established, because that will mean less inflation theoretically going forward. So that's our latest economic data for the week. Let's finish off with the latest auction results. So it's the second last weekend of November. That means we've got, after this week, 4 weekends left until it's all over Red Rover. Now, as I mentioned before, Chad, this time of the year, we usually see higher listing numbers, lower buyer numbers, which means lower clearance rates. Despite what the sort of cycle's doing, it's always a factor when there's more motivation, I guess, from sellers to clear their properties before the end of the year. They don't want to be coming back here next February, starting all over again. So that's why it's a good time to buy, in a sense, because there's plenty of choices, and a lot of buyers have actually bought over the spring selling season, so fewer buyers. And that's why we see clearance rates starting to fall and listings starting to rise over the last month or so of the spring selling season. That's November moving into December. So we did have more auctions, no surprise there, but clearance rates were actually higher. So that's not a bad sign that despite higher auction numbers, generally clearance rates were higher, some exceptions compared to what happened over the previous week. But we're still likely to see clearance rates come under downward pressure because of continuing high numbers of listings. And of course, despite the leverage that buyers have, there are fewer buyers in the marketplace at this time of the year compared to earlier months in the spring season. So these are results. These are weekly results. So we're looking at the full week here compared to the previous week. So 1,487 auctions in Sydney, up from the previous week, 1,446. Clearance rate wasn't too bad in Sydney, 69.3%. That's a good result, higher than the week before, and also higher than the same period a year ago. And you can see how much higher, and we've seen this all spring, basically all year, that listings have been a lot higher this year compared to the same period last year, because it is that sort of last part of the cycle recovery where buyers or sellers come into the market, where we had a lot more buyers last year in a relative sense. Melbourne, another big rise for Melbourne auctions, 1,462. Melbourne clearance rates were down, however, so perhaps affected by that 100 or so extra auctions coming into the marketplace. And listings are still below where they were a year ago, but not too much lower than where they were a year ago. Brisbane around about where it was last year. The Brisbane market's tapered off a bit over the last few weekends. Brisbane, as we explain every week, has a different culture in terms of the auction marketing process. It tends to have that as an adjunct to private treaty sales, so it doesn't have the same, impetus that Melbourne and Sydney have as a sort of a real auction. We have to sell at auction type environment. But nonetheless, that Brisbane market, when we look at other factors, is still growing quite strongly, but clearance rates are now certainly eased well below where they were a year ago, and well below the remarkable record results we were getting from Brisbane earlier this year and in parts of last year. Adelaide also has started to taper off a little bit. Still reasonable results there for Adelaide, but it wasn't so long ago that Adelaide was tracking at near 80% every week in terms of clearance rates, which is quite remarkable, and still just behind Sydney in terms of being the strongest capital city market. And Canberra bounced back last weekend. Certainly a much better clearance rate in Canberra, but the Canberra market's still sort of teasing us a little bit in terms of a recovery. So generally it's what we expect: more listings, lower clearance rates, although clearance rates did more or less stand up last week. So I guess we look forward to next week to see if more listings coming in will have that downward effect on clearance rates. And you can see that trend having eased over the last part of the spring selling season in Sydney, still tracking in the mid 60s, but certainly below where it was in earlier months over spring. Melbourne, not too far below where it's been, but Melbourne's been a real mid 60s sort of a market, as we've mentioned. I'll just talk about Melbourne and Sydney because if you want to get hold of the regional breakdowns from the capitals, we have it in our weekly national report. It showed very strong growth in Sydney's prestige markets last week. Very high clearance rates in the lower north, northern beaches, and the city and eastern suburbs. They had spectacularly high clearance rate. In fact, Northern Beaches was over 80%, and that's really pushing that market or keeping that market holding up. So plenty of energy in the prestige market in Sydney. But Melbourne, the reverse, which just not seeing any action at all in higher price sections of the Melbourne market. Inner east, inner south, and the inner city particularly has had the lowest clearance rate again, and it's continuing to track along the bottom in terms of the regional comparisons. And that's the capital city regional comparisons in Melbourne. So a little bit of a tale of two cities there when we look at the market performance and we drill it down into the regions. As I said, Brisbane's also gone off the boil in terms of clearance rates over recent months. We missed Adelaide there too quick. A similar story with Adelaide and a similar story with Canberra. So once again, it's a question of that easing of activity, clearance rates over the spring selling season, which happens every year, regardless of what's happening in the cycle. If you're looking for the latest auction clearance rates, you can get the weekly snapshot of the capitals every Saturday at around about 6 to 6:30 p.m. Full national report is on my LinkedIn account, Doc Andrew Wilson at LinkedIn, and you get that on Sundays, which does give you the regional breakdowns for the capitals, Melbourne and Sydney, which we've just discussed, and also the top 10 sales under the hammer for each of the capital cities. So if you've missed out on that report, there is a QR code for the latest national weekend auction market report or weekly auction market report, which you can scan, and that will give you a PDF, a link to a PDF file. And finally, as usual, Chad, let's talk about the great Infinity My Housing Market Suburb app. We've got some more news for that. That's a link to the app. Just a heads up, you need a password for that app. You get the password through our friends at Infinity, but it's a great little tool kit for those wanting to know in real time what's happening in the housing market. You can see there, you can look at, and these are every suburb in Australia that has data. Ones that don't have data and obviously not there, and you can search for them either for the price or the data. Now, these are asking prices, so this is telling you what vendors are asking currently, and landlords are asking currently for their prices and rents. You can filter it, as I said, for price and rent You can also filter it for the capital city region or the outside capital city region. Here we're looking at New South Wales, Sydney region. We're looking at Blacktown, big suburb. You can filter it for house, unit or townhouse. We've filtered that for house, and we can also filter for the number of beds. So we're looking at five bedroom houses in Blacktown, and that gives you not just the median price, but also the high and the low. So you know the range of prices that have been asked in any suburb, which I think is a really good forward indicator for those thinking of selling or buying, or just curious to know where certain suburbs are situated. And we also show the number of properties that are for sale in that for that particular that particular suburb. So we also do exactly the same thing for rents. Now we've got an update on our app. We're now showing the top 10 yields. This is specifically designed for investors. So this shows the gross yields for each of the suburbs, the top 10. So we've actually given you the top 10 filtered yields for each of for the top 10 for each of those breakdowns, capital city region, outside capital city region. We also give you the number of properties that are for sale and the number of properties that are for rent. So you can actually start to do your analysis based on some interesting data, returns for investors, and the number of properties for sale and for rent. So that gives you a good starting point for doing analytics on identifying housing market strengths on a suburb by suburb basis, top 10 there. Now, drum roll, Chad. I won't get you to do the drum roll, but next week will include our latest as well as the yields. We've got a link there to the map where each of those suburbs are, but I think people know pretty much where they are. But we're going to have the vacancy rate as well. So you can also get the vacancy rate next to each of those yields. So how's that, eh? So you can also see what the vacancy rates are. So you can look at the highest yields, the lowest vacancy rates, and whether how many properties are for sale or for rent currently. So that's a great little toolkit for those looking for investment opportunities, or just curious as to what their property is returning. This is updated daily, so good luck with all that. And it is available through Infinity, but you've got to get the password from the folks at Infinity. Next week we're going to look at
if I can jump in there, for those that aren't using that tool, it really is incredibly powerful. Doc, we spoke about the weekend gone past, and I used that tool over the weekend, sitting down with clients that were assessing a potential property acquisition. They were looking at potentially buying property off the plan and wanted some price point comparisons. We were able to break it down to that particular suburb, as well as look at surrounding suburbs, potential replacements, and they could get an idea of their pricing now versus what they were looking to potentially purchase for 2 years down the line. It allowed them to make a really clear and really accurate decision. So your data and that app, Doc, thank you so much. It's so powerful, and I'm really looking forward to those updates.
Well, that's what we're here for, Chad, Infinity and My Housing Market, and that's to provide all the latest news, but also evidence-based decision-making. And that's what we do. We provide lots of evidence, real time, and it is all about making informed decisions. And that's what we want, particularly if you're investing in property, because we're not talking cheap stations here. Well, we are, I guess, but it's certainly significant financial commitments, and you want to have all the ducks in a row before you do that. And that's what we try to do here. It's not just commentary. Plenty of opinions out there on the housing market, and a lot of them are questionable opinions. You've got to understand what the motivation is for a lot of these sometimes erratic types of commentary points. It is a lot of it's clickbait, unfortunately, but we work from the data upwards, data, information, and then knowledge and wisdom, and we're trying to give buyers and sellers all the wisdom they can get from our data, but we help join the dots about all that. So next week, the labour market data, latest labour market data, the inflation rate. We're actually going to have a bit of a chat next week, Chad, about underlying inflation versus headline inflation. I've had a few questions lately about defining that more, I guess, in some depth, so people can understand that. We're going to do that next week, so it's a bit of an inflation week, and as usual, the latest auction results. So I can hardly wait to teach everybody about inflation next week. And if you're looking for the whole report from today, there is a QR code. You can scan it, take a picture of it. it'll give you a link to a PDF file for the full report today. So here we go. Another week's gone. Chad, only we've got weeks and weeks and weeks to go, because we don't take a break here, because really, even though it is a holiday market, as I said, a holiday market coming up, there'll still be plenty of data coming through to analyze. And the one thing we can look forward to before the end of the year will be our preview for next year. What is going to happen in housing markets this year, according to our insights. So look out for that one, Chad. So it's been great to chat, Chad, as usual, and we'll see you all again next week.
Wonderful, Doc. Thank you very much once again for your time. Thank you so much for the incredibly valuable data. Looking forward to the inflation chart next week, Doc. We'll see you then.
Yes. Yeah, good one.
See ya.
See you, Chad.